Your retirement portfolio may already own this story. It just might not know what to call it. Somewhere in your index fund sits a memory chip. That chip is becoming one of AI's most contested resources, and the companies fighting for it are spending aggressively. NVIDIA and SK Hynix recently announced a multi-year partnership. The goal is advancing memory specifically designed for AI factories. That phrase deserves a closer look before moving forward. AI factories are not regular data centers with software upgrades. They are purpose-built facilities running enormous parallel computing workloads. Those workloads require memory that transfers data extraordinarily fast. Standard memory chips cannot keep pace with modern AI processors. This mismatch is the supply bottleneck most investors haven't spotted. The specific technology at the center is called HBM. HBM stands for high bandwidth memory. It stacks memory chips vertically to increase speed dramatically. SK Hynix currently leads global HBM production by a wide margin. Samsung and Micron are competing aggressively to close that gap. NVIDIA depends on HBM to power its AI accelerator chips. Without sufficient HBM supply, AI infrastructure spending faces a hard ceiling. That ceiling matters for every company building AI capacity today. Consider what is actually happening across the broader economy. Cloud providers are committing hundreds of billions to AI infrastructure. Enterprise software companies are embedding AI into every product they sell. Pharmaceutical firms are using AI agents to accelerate drug discovery. Each of those workloads requires memory, processors, and sustained power. The memory requirement is growing faster than production capacity can respond. SK Hynix reportedly saw HBM orders booked well into late 2026. Demand from AI customers is structurally reshaping their product mix. Lower margin commodity memory is being displaced by high-value HBM production. That shift improves revenue quality in ways traditional metrics may undercount. Now, follow the chain one step further into adjacent sectors. HBM manufacturing requires extremely precise semiconductor fabrication equipment. Companies supplying that equipment become indirect beneficiaries of the capacity race. Specialty chemicals used in chip production face rising demand alongside equipment. Electricity consumption at HBM fabrication plants is expanding significantly. Industrial power infrastructure serving semiconductor regions faces sustained pressure. Long-term investors with broad index exposure already hold pieces of this chain. The question is whether that exposure is concentrated or well distributed. Large technology index funds often hold semiconductor companies at significant weights, but the memory-specific companies within those funds may be less visible. Investors may want to research where memory fits within existing holdings. This matters differently depending on your portfolio structure. A broadly diversified index fund provides diluted exposure across the chain. A technology-focused fund may carry heavier concentration in key players. Neither is automatically better, but awareness changes what questions you ask. The retirement dimension of the story runs through earnings stability. Memory chip companies have historically been cyclical and volatile earners. Commodity memory prices collapse during downturns and spike during shortages. HBM partially breaks that pattern because AI customers are signing longer agreements. Longer customer agreements create more predictable revenue than spot market pricing. That predictability changes the earnings profile in a meaningful structural way. It does not eliminate cyclicality, but it moderates the deepest troughs. For dividend investors or retirement savers, earnings stability matters significantly. A company generating more predictable revenue can sustain capital returns longer. There is a serious counter-argument that deserves honest attention here. AI infrastructure spending is currently running at historically extraordinary levels. History suggests that spending cycles of this scale eventually experience corrections. If AI revenue growth disappoints the companies funding this infrastructure build-out, spending could slow sharply. A sudden slowdown would pressure memory chip demand almost immediately. Additionally, Samsung and Micron are investing heavily to expand HBM capacity. If supply catches up faster than expected, pricing advantages compress quickly. SK Hynix's current lead could narrow within 2 to 3 years. That compression would reduce margins precisely when investor expectations are highest. There is also a geopolitical dimension that adds real uncertainty. South Korea hosts the majority of advanced HBM production globally. Taiwan produces the leading-edge logic chips that HBM connects to. Both locations carry geopolitical risk that supply chain models rarely price fully. Any significant disruption to either location would ripple through AI infrastructure globally. Long-term investors with multi-decade horizons cannot ignore geopolitical supply concentration. The New York City School District's new AI bias review requirement signals something broader: Government bodies are beginning to regulate how AI tools are deployed institutionally. Regulatory compliance costs could slow AI adoption in specific public sector segments. If adoption slows, some near term infrastructure spending forecasts may prove optimistic. That would reduce memory demand growth from current projections. The honest answer is that this story contains both structural strength and genuine risk. The structural strength is the mismatch between AI workload growth and memory capacity. The genuine risk is that spending cycles end, competition intensifies, and policy shifts. Three indicators are worth monitoring as the story develops over time. First, watch HBM pricing reported in semiconductor industry publications quarterly. Stable or rising HBM prices confirm that demand continues to outpace supply. A sustained price decline would signal that the supply gap is closing. Second, watch capital expenditure guidance from the major cloud providers. Companies like Amazon, Microsoft, and Google regularly update their infrastructure spending plans. Significant reductions in their CapEx guidance would reduce memory demand forecasts meaningfully. Third, watch inventory levels at memory manufacturers in their quarterly filings. Rising inventory combined with falling pricing is the clearest warning signal available. Low inventory with stable pricing confirms the shortage remains structurally intact. These three indicators will tell you more than daily price movement ever could. If you find this kind of macro to portfolio thinking useful, consider subscribing. One clear signal, one economic chain, one portfolio implication every week. The real question for long-term investors is not whether AI spending is real. The question is whether the infrastructure it requires reveals durable economic shifts. Memory may be the most underappreciated constraint in the entire AI build-out. Which part of that constraint lives inside your portfolio today?